We could also talk about stock prices, booming stock markets, and so on. This has totally different implications for people's saving and their wealth today as opposed to 100 years ago, because today most people have a stake in these assets that are appreciating. And what it did to what it has done to wealth inequality is that despite the enormous growth in the prices of financial assets, but also housing assets over the last 2-3 decades, we haven't seen an like equivalent growth in wealth inequality or wealth concentration.
Okay, welcome everyone, and welcome to Daniel Waldenström. Quick background on Daniel, who is a professor of economics with the Research Institute of Industrial Economics, received his PhD in economics from the Stockholm School of Economics in 2003, and thereafter worked as visiting assistant professor at UCLA and global fellow at the UCLA International Institute from 2003 to 2004. In 2009, Daniel gained his second PhD in economic history at Lund University. Perhaps more salient for today's conversation, Daniel's also authored a couple of books. Maybe a little over a decade ago, co-authored Sick of Inequality, and just last year published Richer and More Equal, A New History of Wealth in the West. And Daniel, I stumbled across your work and your thinking with the interview that you did with Michael Shermer a couple months ago. And so that's what got me curious in your research efforts and piqued my interest in wanting to have you on the show. So Daniel, welcome to ReSolve Riffs. To get us started, I was hoping, I warned you before the show that maybe we would try to go back a little further into your past than maybe other interviews have. So I was wondering if you could give us some insight into how you grew up, and well, maybe first start with what exactly you focus on, and then we'll talk about how maybe your upbringing and your early studies led to you to become curious and doing more work in this field.
So thank you guys for inviting me and talk about these questions that are, both my work but also my hobby, I would say. So I'm a professor of economics doing academic economics research, focusing on questions on growth and distribution. So how do the economies develop? How do we, get to live a better life? But also how to make that broadly dispersed in the population. How do we get people to feel engaged, but also so be taken care of? But so finding the balance between promoting people's efforts and making them want to grow and want to expand in society, but also then how can society help in terms of redistributing by taxing people, but also then supplying the needs to and the social safety nets and so on. And where do we strike a balance between retaining the incentives, the carrots to people, but also then offering broad solutions for society to work well as a whole. So growth, inequality, taxation, and also do some policy work and policy advice in Europe, I would say, like Sweden, Swedish government, different colors, and also European level, EU Commission, OECD, and so on. So, that's basically what I do. I do some supervising of graduate students as well, but then this is what I do.
Thank you. So Daniel, maybe take us back to your upbringing. Were you always interested in this kind of subject matter, or was there something in your early life or maybe in your early studies that triggered a particular interest in this focus?
Well, you could say I kind of grew up in Stockholm, Sweden, or in a suburb of Stockholm, in the 70s, 80s, living a relatively good life, I would say, then in some kind of middle class framework with parents, coming out of university, working in like these kinds of more academic professions, but also there are some of these longer ties with banking and so on. Uh, and that was an era of so political engagement, I would say. My parents coming out of the baby boom generation that kind of protested against the older conservative society that they grew up in, and wanting to you know improve on society. You had the Vietnam War was very influential in Sweden, and you had so those kind of sentiments, I think, infused me into like political interest, I would say, at an early age. So when I became a teenager, I kind of interested in societal issues, politics, and more of a social scientist than like some kind of natural like or science or math person. So I came in from into economics more from that background. Also history. I've always been interested in history. So well, Sweden also then lived through a pretty serious economic crisis in the early 90s. So we had some centuries of very low unemployment rates, high growth rates, but as it happened, also high inflation rates, stagnation, hollowing out of competitiveness, as most European, also the US and North American economies had in the 70s and early 80s. So that in Sweden, the market failures or the market underperformance was really grave, and we lost a lot of industries. We had really high inflation rates, bad policies that gave us this really deep economic crisis. Unemployment levels went up from maybe 2% to 12% within a couple of years. And we have bankruptcies, banking crisis, and so on. And I think many people then, I was then like a teenager, became interested in wow, what's happening, and we understood that economics matters. Then I kind of understood that I wanted to understand. I needed to know more in order to really get to know the facts. So I think that was kind of channeled me into studying economics as a topic.
Okay. Um, and particularly, development economics, I guess, right? Um, what are the progenitors of sustained growth? The progenitors of um, wealth generation, the dynamics that lead to increasing or decreasing inequality. Did that fall out of any early courses in university or any experiences, academic or otherwise, at that time in your life?
Well, not exactly actually. So I think I was primarily interested in historical questions, also the financial industry. So I started looking at the interactions between policy, like political events, and financial markets. So stock trading, taxation of stock trading, also then within an historical context. So that was more of how was what I did some research on in my dissertation in economics at the Stockholm School of Economics. And then I was invited, or I got a job at UCLA as an assistant professor, and there I met Emmanuel Saez of Berkeley University. He gave a presentation on the wealth inequality in the U.S. and its development over the 20th century. It was a really great paper with Wojtek Kopczak, who's now at Columbia University. So then I had already felt that some parts of the financial sector was kind of unreal. I mean, it's almost by construction, not part of the real sector, but I
Mhm.
felt, I needed to know more about how people fare. And so I think and with my earlier political interests, I think I kind of realized that the development, or like, yeah, development, but also inequality dimensions were like what I wanted to look at. So then became interested in what Emmanuel had done, and also Thomas Piketty in Paris. Uh, and then we could come back to this, but I think at that time, I didn't really think that growth and development was that important, even though I knew that it existed and I've studied it. And I think this is actually something we need to talk about that many inequality researchers, but also people interested in inequality, have a problem of not really understanding that, in order to have something to tax, we also need income, we need profits. So not only the division of the pie, but the size of the pie. And I think this is something that I've started to realize actually even later, during the later years. And I think this is also what was kind of the key driver behind my book on so richer and more equal, which is where I really try to highlight, that those two sides, both the size of the pie and also the division of the pie.
I'm curious to maybe circle back to the crisis that you mentioned in the early 1990s, which you said you grew up in the 70s and 80s, so that you're a young adult, probably out of university.
Yeah, you
And
can see
just
that from my
just in the
color from
fact,
here, right? Sorry.
yeah, I wasn't going to go there, but I think what we're trying to get at is from the outside. I've never been to Sweden. I think a lot of people's views on Sweden, it's usually remarked along with the other Scandinavian countries as this beacon for social democratic policies, more homogenous society, a more equal society. And so the fact that you grew up in Sweden, you're a Swedish guy, and your the outcome of your research and the focus of your academic life has been on how you lionize capitalism and its effects on bringing up the bottom half, let's say, of the income distribution, might strike a lot of listeners as surprising in a lot of ways, given the more social democratic bent that the Scandinavian countries seem to have. So I'm curious if perhaps that episode in the 1990s, were there particularly bad policies that you remember that the Swedish government imposed, and maybe what those were would be interesting to understand.
Oh, I mean, it's a great question. I think this is something that's actually really on the agenda as of today as well. Maybe I didn't really understand it at the time, but so the policymakers, they of course wanted to do as good as possible. They wanted growth. All policymakers say they want high growth and so on. The problem is that many of them don't understand what's needed in order for growth to happen. I think some of them, I think this is particularly problematic for people interested in like maybe inequality, but also policymakers maybe leaning towards left side of the political spectrum to see like the means of society as given. So they're there. We're not seeing the efforts required for growth to happen. So, for example, what happened was a lot of deficits. So deficit spending, meaning not first make sure that the means are created in the private sector, but instead policymakers could borrow from future taxpayers, raising government debt without needing to prioritize between different areas. Because if you borrow, you can just like add resources. You don't need to take from some area, and this is what that kind of destabilized the Swedish economy during the 1980s. It generated like spending, which then in turn generated higher inflation rates, built up a fiscal balance that also made creditors worried, leading to higher interest rates. So that increased the pressures on the budget without really solving the underlying problems of competitiveness on really the growth derivatives that are needed. Then we also had some other aspects at that time in terms of like we had a fixed exchange rate that was pegged towards like a basket of European currencies. And as you may know, so if you have like committed to a certain exchange rate and there is like these speculative attacks, then and typically also this fixed exchange rate may over time be off with respect to your like the competitive level of your economy. That became very expensive. And then so that was just part of the imbalances that were being built up. But as far as the deficit spending, the lack of commitment and long termness of politicians, I think that is a really grave problem that especially Europe is suffering from today, as you can see. I think that was aggravated during the pandemic, but we had it before. Many of the over-indebted economies, just continued borrowing, and they do still continue to borrow. France, for example, has a really large government debt, and they have low growth rates, and yet their latest budget was like some 5-6% of GDP deficit, just signaling that these guys really are out of hand with what's needed for them to create long run stability. So really what we experienced 30 years ago, and this is something that Europe is experiencing right now.
So that's a really interesting framing of the Swedish economic crisis in the late 80s, early 90s, because my recollection of it was that it was centered around real estate and loose lending standards by Swedish banks, especially in commercial real estate. And so the banking system got over leveraged with asset-backed loans. And then there was an interest rate spike and some inflation, which obviously was probably the trigger for a collapse in the real estate bubble that had accumulated over sort of the 5 or 10 years previous. And this kind of gets into some of the frictions or tensions I have found with some of your conclusions and your analysis around wealth, right? So just taking the Swedish example, obviously there was an enormous credit bubble. Maybe it wasn't obvious at the time, or it was obvious in retrospect, but it wasn't obvious as it was accumulating. It had an enormous wealth effect, right? For a time, I'm sure Swedish citizens felt very wealthy, right? During the accumulation of this credit bubble and the increase in commercial and residential real estate prices. So, I just wonder, to what extent are we confabulating maybe a wealth effect, because you do make the point that over since the 1980s, certainly since the early 1900s, global wealth has increased, and it's not just increased for those at the top of the food chain, but for those at other strata in the food chain. To what extent are we confabulating or conflating asset price bubbles with a general wealth effect?
Okay, so there are several topics a little bit. So just very briefly on the 1980s episode in Sweden. So you're perfectly right. So I think what we did was to deregulate the banking sector in the mid
Right.
1980s. So this was part of the kind of the political. These were part of post-war or like Second World War regulations. So we had regulations of the financial industry. So all the banks, basically were required to do things that was steered by the finance minister or the central bank, in terms of how much to lend or how much at what interest rate. We couldn't have capital flowing across borders. We couldn't taking active part in our economy because of these regulations, capital account regulations. Our tax system was such that borrowing was really supported, or you could say subsidized by high deduction possibilities. And then when we deregulated the banking system, because that was just part of what was kind of lacking in a dynamic economy, the problem is that we stick with our tax system that promoted borrowing and having these deduction possibilities, making it very beneficial to borrow a lot. So it's kind of boosted borrowing and construction, and so on. And we had a bubble. That's right. I think though that was more like, so that was the bubble that kind of burst in a sense, when we redesigned the tax system in the early 90s. But I think the deeper economic problems and political problems were in place in the 1970s, I think, throughout the Western world, and they kind of outlived the 1980s. And also then for Sweden, then created this much larger crisis in the early 90s. But fair enough. As for the other question that you raise, and I think it's very kind of interesting about what is wealth and how is wealth generated, and what you allude to in the sense of housing prices going up, you could also have new buildings, of course. So this is basically how wealth is created. Either we save, it's a kind of volume growth of assets and wealth, or we have price gains, relative asset price gains. And that we can have actually both in terms of the non-financial assets, the property or the housing or the houses, or at the financial side, of course, we could have capital gains. And so there is definitely the case that a large part of middle class wealth growth over the last 2-3 decades, you could say, in many Western countries has been asset price driven. So, and this is shown by some scholars for different countries. So, and we see in fact relative price gains or capital gains are relatively dominant in middle class portfolio growth, whereas in the higher end of the wealth scale, we see much more of like new savings or like maybe gains from income or whatever that makes you expand in like buying new assets. And this has made people think, what happens if prices drop, if prices fall? Uh, or whether there is like some kind and how to interpret these kinds of gains. And I think there's no really simple answer. I mean, wealth is a very complex outcome in this sense.
Mhm.
Uh, so capital gains, unrealized capital gains, are kind of paper gains. So they don't really change your life very much, depending, as you know, I mean, if your house becomes much more valuable, still your house, it provides the same services. So there's like so the liquidity dimension or the interpretation of different kinds of assets becomes important here. But well, I don't know. I don't know if this was not an answer really. This is just like some thoughts. But let me hear what you have to say now.
No, it's a good point, and I put the cart before the horse a little bit with my question, right? So why don't I allow you to describe what you investigated for your book and probably what you've investigated as kind of your life's work over the last decade or so, and then talk about some of your main conclusions, and then we can follow up with some challenges potentially.
Yeah. So thanks for reminding me about like bringing forth my thoughts on this. So what I kind of found when looking at the data in terms of what wealth is, what kind of what kind of wealth that people hold, and how this has maybe changed over time, was precisely the fact that uh, all of a sudden the stuff that you and I own, and what is that? The popular wealth that people sometimes have branded it, are basically our homes, our dwellings. That's We know it, like it dominates most people's total portfolios in all in the aggregate, but also in the micro, like the household level. Uh, so that is, and also we have long-term savings. We save primarily for old age. So this is something that we as households always have wanted to do, but as it turns out, looking at the very long time perspective, like 100-year time perspective, it turns out that maybe some people did, many people didn't. Because why? People were too poor to save. So basically, all that they earned, they had to eat. We were underdeveloped. So looking at the aggregate, the total amount of housing wealth and also long-term savings is like maybe a 1/4 of all wealth in society. And the rest was other things. What was that? Well, agricultural domains, uh, land, forestry, and so on, but also industrial capital that grew in our economies in the early 20th century. Over then time, this has changed. So why? Well, people started becoming more educated, better paid, starting to build their lives. This is something we have not, perhaps our generation have not seen that, but our parents have seen it. I think they have been part of it, and their parents were kind of in the midst of it. So normal people could basically start buying homes. And our parent generation, 40s, 50s born, some of them are still the first ones to get a university education. So these are real growth developments. And what happened was that people started building, their own saving and building their own portfolios. So, and today, when we look at the aggregate, 3/4 instead of 1/4 of all wealth are made up of housing and long-term savings, pension funds, and so on. So that is like this huge shift of the 20th century. And what it does is that whenever we have, price changes in the markets, so we talk a lot about housing prices and house price, maybe inflation, but doesn't matter. We could also talk about stock prices, booming stock markets, and so on. This has totally different implications for people's saving and their wealth today as opposed to 100 years ago, because today most people have a stake in these assets that are appreciating. Not everyone, but a lot of people. And what it did to what it has done to wealth inequality, which is then the other big theme of my work and also my book, is that despite the enormous growth in the prices of financial assets, but also housing assets over the last 2-3 decades, we haven't seen an equivalent growth in wealth inequality or wealth concentration. We could let US be a little bit aside for the time being, but if we will look at basically all European countries, but also Canada, Australia, so despite asset gains of 200%, 300% between, say, 1990 and 2020, uh, top wealth shares, the richest people's share of all wealth, has not increased a lot. In some countries, it hasn't increased almost, it's basically flat. And this is because, yeah, we've had a lot of new entrepreneurs building new companies and so on, but the values of our economies have also increased, both in terms of no savings, but also these asset price gains, then dampening or basically balancing out the wealth growth in the top. We can then talk about why we had these asset price changes and so on, but this is just like looking at the value of wealth as we measure it, namely the current market price of our assets, and we see that since people have started saving and owning to a large extent, middle class people, they are also part of these asset price increases, meaning that despite the value creation, we haven't had the boost or growth in wealth inequality. And I think this is worth pointing out. And this is completely different from what we experienced like a century ago.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investresolve.com. Now back to the podcast.
It sounds like the reason why you would put, excuse me, the U.S. aside is that because the stock market in the U.S. plays such a magnified role as a savings vehicle for the U.S. population, much more so than any other European or Western country that would come to mind. Is the access to real estate, to owning real estate, what has been the main driver of wealth accumulation for that bottom half of the income distribution? And is that maybe the main reason why you would put the U.S. aside? Because in the U.S., so many people also own such a large amount of stocks, and that has kind of shifted the perception on asset ownership and wealth effect.
Actually, not really. So things are, of course, complex, and so the reason I wanted to put U.S. aside a little bit was that whereas basically all Western economies have not experienced almost any increase in wealth concentration. So measuring this by like the share of the rich relative to others, So these trends have been almost flat. There have been some changes, but they're very small, especially historically, in almost all Western economies, except for the US. I think and that's why I wanted to take US a little bit aside. In the US, we've seen much clearer increases in wealth inequality. But I don't think that's the main reason. In fact, that would be if more people are kind of participating in stock market ownership, they would also be part of that. And actually, this is what we see. What is where the US is actually kind of a little bit departing is that their top guys, their successful business people, have been the most successful globally of any country. So their wealth growth has been faster and more pronounced than in other Western countries. So they have kind of, even though middle class people have experienced high wealth growth, the top guys in the US have experienced the highest wealth growth in the world. So this explains why wealth inequality, wealth concentration has increased in the US quite pronouncedly. So in the US, you have other kinds of, you had the financial crisis where the middle class in the US took pretty big hits in their home values, which I think was more pronounced than maybe some other Western countries. But as for participation, I think also, in fact, Sweden, being a very small country, but we have pretty high financial market participation rates, especially when it comes to mutual funds. That's been a very popular saving vehicle in the US, in Sweden as well as in the US.
How
So I
would you
guess the
characterize the trajectory of this change in the distribution of wealth over time? Right. In my research, I noted that I think you sort of primarily start your observation in the very early 1900s, and then sort of paint the trajectory of wealth inequality. When does that? How did that look in the very early 1900s? You did touch on that with a large concentration in agricultural wealth, that sort of thing. What was the arc of that transition over 70 or 80 years? When did that kind of when did equality peak, let's say, kind of globally? And then what's happened since, and then we can maybe talk a little bit about why.
So looking at the facts when it comes to national level wealth inequality trends. So what I do is to basically collect the numbers that we have for a few countries, maybe a handful, maybe up to maybe a dozen of Western countries. And what we see is, when measuring wealth inequality by the share of the richest guys, the richest, for example, 1% of the entire population. This means lining up the population from the poorest to the richest and dividing the population into hundredths, so 100 groups of equal size. Then we take the richest group in that population and add and count or measure all their wealth and relate it to the total wealth in the country. In the early 1900s, the share of this 1%, the richest 1%, was between 50 and 70% of all wealth in the Western world, meaning that like 100th had commanded basically more than half of all assets in the entire population. So I think the UK then had at some point maybe 73% as the kind of the peak of the inequality in the early 1900s. In fact, I think this is the highest degree of wealth concentration that any human society has ever seen. So we know that earlier societies were not as unequal in wealth holding because there weren't that much values. So the values started being built up during like industrialization, and then they went down during the 20th century. So that's around 1900, 1910. Then we have a peak in wealth concentration in the Western world, and after that, concentration starts decreasing a little bit differently in exactly when they start in the different countries, but it starts decreasing during the 1910s and continues throughout the 20th century, 20s, 30s, 40s, 50s, up until around the 1970s. when it flattens out. So then we go from top 1% wealth shares around 50 to 70% down to maybe 20% around the Western world. And this is so then after the 1970s, this is one of my main kind of facts that I want to highlight. So despite the deregulation of our economies, so we started getting rid of the post-war regulations or Second World War regulations, uh, despite the booming housing markets and especially better than stock markets, uh, values increasing by several hundreds of percent, we have not witnessed then any similar vast increase in wealth inequality since the 1970s. So those are the data, those are the numbers. The US began maybe a little bit lower actually in concentration, wealth concentration in the early 1900s, coming down to the 1970s around the same level as Europe, but then has shown a clearer increase in wealth inequality rates during the 90s and 90s and 2000s. So those are basically the broad. So when I, broad trends, and I call in the book this for the I call this the great wealth equalization. I think those kind of some people like those brands, and I couldn't find it actually anywhere else. But has really been a great wealth equalization within Western countries during the 20th century.
What have been the main drivers then for this wealth equalization? I mean, I think we've touched on a little bit on this, but why don't you walk us through? I think education plays a major role here and institutional reform. So, kind of maybe, and if you might be able to rank them in terms of hierarchy, what do you think is perhaps the single most important variable that has driven this, and then work your way down?
Okay, thanks. And this is actually, but let me just mention that this is actually one or the main new things that I think I have contributed to highlighting with my book and also with my research. Namely, I mean, it's a kind of why the subtitle of my book is called "A New History of Wealth in the West," and the reason is the drivers between this equalization. Here, I actually depart from my old colleague Thomas Piketty, and whereas where he highlighted shocks to capital, so wars, crisis, but specifically wars, uh, as being the main driver of the wealth equalization. So you could have had outright capital destruction, bombings of factories, and stuff that the rich owned, but also you can have wars coming with regulation of societies that hampered the rich or like slashed the wealth of the rich. And then we had and then he proposes as a second channel capital taxation that came up during the 20th century, especially during the post-war era, with like inheritance or estate tax rates being at very high, capital income tax rates, profit or corporate tax rates. Basically, so according to Thomas Piketty, but also like Walter Scheidel, a historian at Stanford, who has said like the wars are a necessary condition for sustained wealth equalization. So they kind of aim at factors lowering the top of the distribution and thereby creating equality. I don't think that this is really the factors that we want to look at. I don't think they are that important at all. I think they have contributed, but they are not at all that important that they have kind of highlighted. In fact, instead, my book, and I think I lean on others like Daron Acemoglu, Jim Robinson, like Doug North, of course, and Lance Davis, and many of the economic historians promoting the view of uh, economic growth generating values that, in combination with political changes, economic changes in the 20th century that allowed for these new values to be more widely dispersed, namely the democratic events, the extension of suffrage, the educational reforms, labor laws, and so on. That is what has changed totally our lives, and that has lifted bottom of the distribution, so allowing people to start saving in housing and pension savings and so on. And so I will come back then to talk about perhaps some of the magnitudes. But so this is then, instead of having the shocks to capital, slashing the wealth of the rich, lowering the top as the main drivers, as Piketty has promoted as main causes. I instead promote that it's lifting the bottom. And here, so democracy. Democracy is then key to understand this, the kind of the inclusiveness of the institutional changes that came during the 20th century. This is kind of almost like a 0-1 thing. All of a sudden, you have to take into account that people can have a say. You can get ousted as a government and so on. So we had democracy, kind of pseudo democracies, and this has kind of come gradually, but then we see that over time we had changes. I mean, in my book, I highlight the educational system, which means so schooling becomes broadened, access to higher education is expanded to more groups, like professionalists, people with skills become more and more like larger and larger share of the working population. And also we have labor laws, we have trade unions being able to empower people to ask for better work conditions, maybe restricting work hours, having more say on environments at the working place and so on. And all of this raised people's productivity. We see that incomes go up. We see that wage rates and labor incomes increase as a whole. And this is done especially for the laborers, normal workers. And I think this is like connected to then this new kind of institutional setting where we had to take them into account when kind of promoting the educational or the economic development of our societies. So I wouldn't be able to rank, unfortunately, like education or labor laws or maybe some variants of this. But so then democracy is key. And then, but then don't forget then the other part, namely the growth thing, the growth part. So technological change, industrial revolution, bringing more gains to society. And here we also have private property rights. And I think that is, if like democracy is very important, I think private property right is perhaps the key institution for value creation, for wealth creation, or that in all dimensions, perhaps the most important one. And that we had too. So we had our legal systems securing private property rights to people. That came earlier. And that was probably very important for the industrial revolution to take place in the first place. And then after, during the 20th century, having then the technological change, economic growth, and then we have people being able to take part in this. Then this plays out either through people starting buying homes. Of course, then also thanks to financial development, banks becoming better to mortgage home purchases, and then with the pension systems being built up in various forms. You could have employer-employee, you could have like trade unions being part of this. In the private sector, you could also have state solutions or government solutions. This was then, and the other kind of main asset that people started building up during the 20th century. Here, of course, mutual funds as a financial innovations also helped ramping up growth potential in pension savings. Okay, so at least, so this is the broad picture. We can go into details, but this is at least the broad picture.
Well, I think it's worth exploring some of the differences between this evolution in the US and versus ex-US, right? Call it Canada, Australia, New Zealand, Europe, and the UK, right? So maybe let's start with Europe and the UK, and then we can sort of transition to a discussion of the US as maybe a bit of a special case.
Okay. Yeah, sure. Oh, do you want me to?
Yeah, what happened? What happened in Europe? Like it seems
Okay.
like
Sorry.
this wealth concentration or wealth equalization, I guess, really um, that peaked in the late 1970s, very early 1980s, has stabilized in Europe, right? So, first of all, why hasn't it continued to go down? Um, and why has it stabilized? And then maybe we can contrast that with what we've seen in other jurisdictions.
Okay. Thanks. So yes. So looking first at when we look at the European countries, maybe well then also I think well Canada, Australia, and so on, the entire kind of Western offshoots. I think what is striking is how similar they are actually over the 20th century. So, as I said before, the levels of concentration were very high in the early 1900s throughout the Western world. And then we see this equalization also throughout the Western world. And this is kind of interesting because the countries are kind of different. So US or like yeah, well, US also equalized, but UK and looking at Europe, then UK, France, Germany, Sweden, Spain, they were kind of similar, but also different because in terms of war experience, we know the big ones, big countries had like really rough war experiences during the First and Second World Wars, whereas Sweden didn't even take part in any of these wars, and yet experienced the same equalization trend. Uh, Meaning that I think this is kind of exhibit A against wars as being a key driver. Of course, wars can affect also non-belligerent countries like Sweden through war economies spreading and war regulations, and this was indeed something that Sweden was affected by, but still, wars as a main or a key driver, necessary kind of condition for wealth equalization is clearly not really kind of a strong conclusion coming out of the historical data, I think. So, and also, we could also think that some of these other things that differ across these countries are not playing out so much in the wealth concentration evolution. But then, as you say, this leveled out. The equalization stops in the 1970s. Why? Well, I mean, this is now getting into an area where we don't know exactly why we have a certain level of dispersion in wealth or even in income. So we don't know also from theory what is the optimal level of income inequality or wealth inequality. But we know that wealth is more unequally distributed than income as we measure it. Why? Well, we know, for example, that uh, looking at the distribution of people owning wealth and not owning wealth, we see that almost half of the population has almost no net wealth. So, which is different from income because it's not that half of the population has no income because you need to have income in order to survive, but you don't need to have wealth in order to survive. Why? Well, I mean, a large part of the population not having wealth are young people. People just becoming adults, maybe going into higher education. They can't save because they have almost no income, and they don't need to save because they basically live their lives and they study. So a fair share, maybe one third, maybe half of all the zero net wealth owners, net wealth people in the population um, are young people. And then we have people who have like maybe they have very little saving. They don't want to save. Why? Well, they don't want to say privately because they pay taxes, and these taxes give them the right to unemployment insurance if they become unemployed. Their kids can get schooling and even university education. In many of these countries, that's cost free. Uh, and also when they get old, they have elderly care and so on, healthcare basically provided for everybody, but also specialized care, uh, meaning that after all the taxes, they don't have a very high income, so they can save privately, but they actually don't need to. Meaning that with half of the population not holding wealth in the net, we would have to begin with relatively high inequality levels. So this means that, and where exactly would that be? I don't know, but I did a kind of a simulation of a population looking exactly the same, but the only thing that differed was their age. And just from the age, we would have like the famous Gini coefficient, which is an inequality measure from 0 to 1, with 0 being no inequality and 1 being that one individual has all wealth. And we would have, only looking at the age differences, we would have maybe a Gini of zero point 0.2 or 0.3, meaning that the life cycle effects are very imminent in understanding or explaining wealth inequality. So when we had this flattening out of wealth equalization in the 70s, we may be approaching a level where our stagnating economies don't generate a lot of new wealth. So our wealthiest entrepreneurs were historically, I think, relatively poor, but still it was, so, and we would have a large share of the population not having a lot of wealth, giving us some Gini coefficient of maybe 0.6, 0.7, and a top 1% share of maybe 20%. We couldn't maybe go much lower than that, simply because of these reasons. And also the US, I mean, I think this is something, I mean, I think up until then, I think we have a large commonality across Western countries, actually. But then in the areas, or like in the years thereafter, then we've had some differences, I think, economically, but also policy-wise. And this could also matter for why we have differences in these developments. And I think um that will help us understand why do we have that much of the kind of the growth, the new technologies that we've seen, and the dominance of some larger economies have become more and more oriented and more centered around the United States and not in other countries. In fact, looking at the top corporations in the world, in terms of market cap, the share of the US has kind of increased, I think, quite markedly over the last,
Profoundly.
profoundly, exactly, over the last like four decades or something. And
When
yeah, sorry.
No, as you're describing this, I'm wondering if the bottom half of the U.S.'s income distribution, how that compares to some of the other Western countries. Because as you're describing this, it occurs to me that, and you correct me if I'm wrong, but that's an aspect of your argument is that some degree of inequality is perhaps a necessary condition for much larger growth and perhaps even innovation. I mean, the fact of the matter is the U.S. continues to be the country where almost everyone in the world wants to integrate towards, and so you have this influx of talent and human capital, which obviously is one of the main factors for economic growth as well. So allowing for perhaps some of this inequality or perhaps a higher Gini coefficient, perhaps is a necessary condition for you to generate this larger pie. But I am wondering how that argument stacks when comparing the bottom half of the income distribution of the U.S. against some of these other Western countries.
No, but that's a long-standing question. So that kind of relates to both how the cross-sectional differences of the gaps in income, how they look and who are there and so on, but also then the mobility uh, within the system. So how easy it is to improve on your situation if you work hard, for example. And here, researchers also like try to understand like how mobile is the US contra Europe and so on, in terms of when we look at both within people's careers, but also across generations. So the role of family background. And as it turns out, uh, so so the US has not a much more mobile or dynamic economy, according to most of the studies. So the gaps are very large in the income distribution in the US, meaning not so much that the low income earners are much poorer, but instead that the high income earners are much richer in the US. It's a both bigger economy, market size effects, but also, as you say, the kind of selection of talents flowing in. You just get the best and the brightest globally. Then that effect on the income gaps. But also that makes it more difficult to really reach the top. You need to become much more productive than otherwise. Maybe in some other countries where income distributions are more compressed. So. Uh, so I think, well, you brought up. So this is like there are a number of questions here, but I think here we have a difference. The low income earners in Western Europe, maybe Canada, maybe Australia, have lower incentives or to change their situation because they're better taken care of. So I think these countries Western countries outside of the US are more experienced and I think better in taking care of people who have a hard time. And I think we could discuss levels, but I think, for example, I think when I talk about better, it's not just different. I think it's better because, for example, when we saw during the pandemic, so many of our countries had like systems of automatic stabilizers, basically setting systems so that when you lose your job or so, you automatically get an insurance income, which is set in the system, which to have it practically decided. In the US, I think you had not so much of that. Instead, what you saw was they started sending out checks to people so that people shouldn't like starve, right? This was basically the same as printing money. I think this is also then showing that the safety nets didn't work as well in the US as they did in other Western economies, but also then additionally, I think that may have contributed to the inflation increases, basically that you printed money. So at the end of the day, we don't. It's difficult, but I think this matters. All of this matters to why we get these differences in outcomes. Maybe more of getting high talented people and having higher upsides in the US economy, maybe lower tax rates on high income earners, maybe having lower corporate tax rates and so on. Now, at least, that contributes to people wanting to be in the US and be successful in the US, maybe more than having just like looking at low income earners and finding the explanations there.
So the two primary factors, just I think from reading your work, that have had the greatest impact on this contraction of wealth inequality have been the proliferation of private pensions and the appreciation of and participation in private home ownership. Are those kind of the two big variables that you continue to highlight?
I think so. At least, when it comes to outcomes of what people actually own at the end of the
Right.
day, and looking at people's portfolios, those two are the kind of the dominant assets in middle class households
And then
portfolios.
how do you disentangle? This is kind of where I was trying to go earlier. It was too early in the discussion, but how do you disentangle the impact of just rising asset prices relative to their underlying fundamentals, relative to the accrual of genuine capital, right? So, as an example, the Association of Civil Engineers in the United States forecasts that by 2030 there's going to be a $29 trillion infrastructure deficit in the US, right? We've accrued an enormous liability, or not we, but the US has accrued an enormous liability on the infrastructure side of its balance sheet. On the other side, we have the US and to a great extent, Western democracies have succeeded beyond our wildest dreams or nightmares, depending on how you look at it, in capitalizing future labor income further and further out, right? If you think about a US 30-year fixed interest mortgage, well, what you've effectively done is you've capitalized 30 years of labor income all at once in this, crystallization of this mortgage, which is obviously a bank asset and a homeowner's liability. In allowing homeowners to capitalize an increasing duration or maturity of their future income, that has allowed asset prices to rise in proportion, right? So I find the wealth effect to be very difficult to kind of disentangle what real wealth has accrued and to whom, and has it accrued because we have built new things. There are vastly more housing units or productive enterprise units in these economies, or whether we have just valued the price of existing units at much larger multiples. And how does that impact your analysis and your conclusions?
No, but you're raising many important aspects of why we want to look at wealth, but also why we do not want to look at wealth only in terms of both the kind of understanding the size of the economic pie, so the wealth of our societies, but also wealth and welfare of people. So I think here we need to we need to kind of if you can allow me to, so it will be a little bit like not so crystal clear in all dimensions, because I also think this is like difficult area. This is a difficult domain to really
agree,
to disentangle. So looking just at wealth, the wealth ownership, the assets that we hold and their market value, our measures of wealth and wealth inequality are simply to add up all the assets in our balance sheets, in the the non-financial assets, whatever they may be, land and housing and dwellings and holiday homes and so on, and then our financial assets could be bank savings, could be some mutual funds, and then like stock market shares and pension funds. And this is just like simple accounting, and these values are both in the same kind of volume stuff, the number of assets, but also their market values. And the market values and market prices can go up and down. But what is fascinating is that, yes, it's not that if you want to double your market value as a like a normal working household, you can't just like easily, at least, like construct a new home, unlike an entrepreneur maybe who's starting up a new firm, or like expand services and goods being produced. You just have your home, and then it may go up in value or not. And this is kind of the basic contract that we agree upon. And yes, so the wealth gain for these households is that their house value has gone up. Does it give them more power to influence politicians? Well, probably not. It's just like paper gain as long as they stay in their house, with exception for a fraction of households who have actually been able to actually liquidate some part of that, that asset price gain, namely by taking additional mortgages, maybe by improving on their home, or maybe even buying a car, or doing things, consume.
Yep.
So we've had, I mean, in theory, they could have also started, setting up some political action committee or something to influence politicians. But whereas the liquidity share of wealth held by of the rich households or the rich people is most likely very clearly larger. But still, that said, our asset price change would affect the top as well. So I think during 2022, the market value of Tesla shares or Tesla Corporation decreased by, I don't know, 65% or so. So asset price fluctuations affect both the top and the bottom of the wealth distribution. And this means that it's not really clear at the end of the day where where distributional changes will be the swiftest. We could have financial crisis, for example. They typically hit the rich guys hardest.
Mhm.
We see that wealth concentration goes down during financial crisis typically. And you would also have a lot reshuffling within the top. So some people just get bankrupt and then get kicked out and being replaced by others. So that's one thing. And then the other part, okay, let me just shift a little bit to what you said about infrastructure and the kind of the underinvestment, if one may want to talk about that.
Yeah.
I think here's another kind of interesting ground for comparison between the US and other Western countries. I think I actually often when I give talks, I emphasize the importance of separating out different country experiences, and especially separating the US from Europe. Maybe where Europe should also include Canada and Australia, I don't know, or New Zealand. But simply because we have such large differences and this has to do with how much we tax. So the average level of taxation is an order of magnitude higher in Europe, meaning that we are more ambitious in doing public infrastructure investments or like having collective expenditures that comes into the education system and so on. So the question is then, are we better in doing this at there's one question about should the government do this rather than the private sector, but I think in general I think it's fair to say that the US could do much better in terms of taking care of their infrastructure. I think this is quite clear. uh, and then at the other then to add to this is the role of growth potential in the economy. So if we pick up on growth, and here I think on the other hand, then Europe is actually underperforming. We have a secular stagnation throughout the Western world, but I think growth rates are worryingly low in Europe at the moment. And why this is a big thing to discuss, but with higher growth, could we pick up growth, meaning productivity growth and just like doing better in what we do, maybe doing new things as well. This would give us means to do a lot of good things, both in terms of expanding quality in public infrastructure, but also then generating like more means to people to live good lives. And that then also then adheres to like future income growth would then also have capitalization effects on our assets. So we would then have higher than housing values. In fact, I think a fair share of the capital gains in the housing market over the last 2 or 3 decades is part of the real income increases that we've seen. Uh, Households in most Western countries have fared really well over the last decades, on average, that is. Why? Uh, I think growth has been increasing because of globalization, partly. I think not least the China entry into the world economy has generated a lot of gains, both in terms of lowering like the consumption stuff or like goods and so on, but also their capital flowing in and so on and so forth. Anyway, so there are like, as you can hear, a lot of things are interplaying at the same time. Finally, like interest rates, for example, lowered interest rates is also capitalized in market values
Mhm.
and maybe shares. So of course that could then be offset if interest rates go up. We saw that a little bit a few years ago. This may be the way we come back if we would have military conflicts, and we would have like extreme needs of capital in the military industry or defense industry. Maybe climate investments would then create demand all of a sudden. It would actually demand large investments. So we could have higher interest rate because of that, and that would of course have effect on housing values and as well, but also on corporate values, I would say.
Well, what's interesting too, just talking about cross-sectional differences between, for example, U.S. and rest of the world, or rest of the developed world, call it, is of course that U.S. mortgages are typically fixed for decades, whereas mortgages in the rest of the world are reset every 2 to 5 years. You've got to go back to the bank in Canada and Australia, and I think in most places in Europe and the UK, every 2 to 5 years, and get a new interest rate and renegotiate your mortgage with the bank. Whereas in the US, we don't see the impact of higher interest rates propagate to the same extent through the economy, despite the fact that the US is maybe more financialized than the rest of the world. But just by virtue of the fact that those interest rates are locked in, and therefore asset owners don't experience the consequences of their over leverage in the way that asset owners in other jurisdictions might, right? And so you're going to get a reset of of that capitalized value of future labor, as a function of a reset in interest rates in the rest of the world, right? So um, I think that probably meaningfully, certainly not completely, but meaningfully explains some of the difference in the reaction to higher interest rates that we've observed in the rest of the world outside of the US versus in the US.
This has been this is an area of great concern also in Europe, Sweden, with a large share of homeowners have mortgages that are not even only set by every 2 or 50 years or 5 years, but instead every third month, every 3 months.
Yes, floating rate. Yeah.
Yeah,
Yeah.
so monetary policymakers are follow this very closely, and they were of course really concerned during the pandemic or post-pandemic period. Uh, so exactly what to take out of this? So these are different across European countries. I mean, the French households are much more US-like in the sense of having very long-term interest contracts. Then on the other hand, this is also something where we have like relationships between banks and the borrowers. I think that also depends on how is the banking system structured. What do we have in terms of the guarantees, insurance guarantees for depositors? What
Mhm.
but anyway, but you're perfectly right. So that kind of propagation of interest rate shocks into like household behavior, consumption, and so on, getting more real effects on that is of course something which we are discussing. And there are kind of, in fact, in Sweden, we try to have had some regulation of like ceilings on how much to borrow against certain interest rates, or when you need to start paying off your mortgages and so on. So it's kind of an experimentation, institutional experimentation or policy experimentation on how to get a little bit of less reliance or maybe exposure to these kinds of events. But um I don't know. I don't know what the best scenario is, or what the best, where we want to be on this.
Yeah, I mean, just in general, I've sort of monopolized this segment, Richard, to which I apologize. I know you've got some other questions, but I guess just to tie a bow on this is, um, I think it's very difficult to make strong assertions about wealth accumulation, or the share of wealth in an economy in the presence of financialization, right? Just the ability to capitalize future labor and the innovations in the financial sector, I think, have had a profound impact.
Mm,
And that impact is felt differently in different jurisdictions because of different banking and lending policies, um, and other things, right? But I just think that substantially weakens the conclusions that we can make about wealth accretion, the changes in wealth inequality that we've observed over time. And I think it's more than a coincidence that if you look at the trajectory of um, wealth concentration or wealth uh, equalization over time, wealth tends to be the most equal when asset prices are low, right? In the late 19th set relative to
Hmm.
cash flows, right? When home prices are low relative to rents, when stock prices are low relative to earnings, when interest rates are high and therefore bond prices are low, that tends to be when we see the greatest amount of equality. And when after many years of asset price appreciation relative to fundamentals, that's where we see the most um, uh, unequal share of wealth, and why we also see a much more unequal share of wealth in the US than we do in the rest of the world, because the US has experienced such a massive appreciation of financial assets relative to the rest of the world, which over the last 15 years, outside of the US, there really hasn't been any growth in equity markets. Um, and in the US, equity market growth has been about twice the long term average over the last 15 years. So I think that explains a lot more than maybe we give credit to. And I don't know how you disentangle it, but I think it's a really important factor.
I agree, but at least but only in part. I mean, I think so. So yes, when we get depressed asset values, when we basically, when if the value, the market value of wealth would be zero, we wouldn't have any wealth inequality. That's just like as a corner solution. Let's say in some strange socialist commando economy, or when private ownership is disallowed entirely. Uh, but along that kind of angle, or that axis, in the 70s, yes, markets were dysfunctional, economies were dysfunctional, mass asset prices were low, we had stagflation and so on. And then, as you say, since then markets have appreciated. And you could say they have boomed for several decades for different reasons. Still, not only in the US, market caps have increased a lot also in Europe. Uh, and I think that is one of the striking facts from comparing wealth distributions across countries, is that we have not seen the same level of increases in wealth inequality uh, that we've seen in the US in comparison to what we've seen in Europe and so on. So in Europe, wealth inequality has not increased secularly over the decades since 1980s. That is basically, and this is partly then because, as you say, people's houses have gone up, house prices have gone up, but also that people have started saving also in these financial markets that have become more valuable, thanks to globalization, funded capitalism, so pension funds being built up, uh, perhaps driven by Japanese and US pension funds, like investing in smaller economies and so forth. But again, a little bit picking up on uh, so this kind of capitalization of income. I think here's like where we also want to talk about the role of income and income distribution. So so there is just like so much you can say about wealth inequality in terms of this distributional discussion. So yes, people's wealth may go up and down, or maybe very kind of um, reliant on house price changes, and doesn't really matter for their kind of real wealth, life, you could say. But instead, for them, what is crucial, and also for the economy as a whole, is the income. So as long as people have an income, they're fine. They can they can pay their mortgages, or like they could live good lives. So, and therefore also when you talk to monetary policymakers, instead of them focusing on asset prices and so on, which is very complex, we don't know really how to think about this or the different implications. I think for them to promote equality is to try to reach full employment. So that is what kind of the most by far important dimension in which we can create like inclusion and equality by basically allowing people to live good lives and take active part in the labor market. And then they can, if they want, they can buy a home, they can invest in the stock market, or they could be like hand to mouth and just like go traveling or consume whatever they want. As long and then, so that's my kind of also the take on it. So you may have asset price changes that are not really important for people's lives with house price gains, and giving maybe I get just a feeling that there is like, or people I get these comments whenever I present, people feel like, how could you compare like super billionaire asset gains to middle class people's house price gains? They are just like different universes, and I kind of agree, and yet they're kind of part of like some kind of income wealth complex that at the end of the day want us to live good lives. Uh, yeah, I mean,
Well, yeah, I've got some other
I
thoughts,
like
but I'll
my
let Richard chime in
yes,
here.
yeah,
yeah.
I'm
I
sure
like
you
the way
like.
that you.
Sorry.
Yeah, no, the way you were framing that, I think raises a very interesting and very important point, which is much like when central banks lower interest rates, we see stock markets boom, but that has nothing to do with actual repricing valuations, because the stock market is not narrowly focused on short-term interest rates, but much more on the longer end of the curve. It's more on the transmission mechanism is more about animal spirits and confidence. The idea of asset price appreciation, more so in the real estate uh, element of this, but also in stock prices, because people aren't necessarily selling those stocks and cashing them out. Those are also, I think, play a much stronger role in terms of boosting their confidence in terms of spending. And so that prosperity angle, I think, really comes from when they have the income to improve their lives on a day-to-day basis. Because people might have, very large properties and that are appreciating in value over time, but unless they have the cash flow to sustain their quality of life, they're actually going to be downgrading, selling out. And so the prosperity angle has to be intertwined, as far as I can see, to the income element of this. And this,
Well, I don't. That's the whole point about financialization. Is it disconnects asset prices and spending from incomes, right? If you were able to take a 30-year mortgage on a home with 5% down, the home goes up 20%, then without doing too much complex math, your wealth has increased by 2 or 3 times in that period, your equity in your home, and now that can be used with a home equity line of credit. You can pull that out. You can redo your kitchen if you want, but many people don't. Instead, they take that HELOC and they spend it on a vacation, or they, to Daniel's point, they buy a new car, or otherwise consume, right? And so in this way, rising asset prices subsidizes incomes, so that we don't need to see the same appreciation in labor share of the pie, because labor can, or at least owners labor can take money out of their, unlock their savings by lending against the assets that have gone up in value. And this,
but mostly the U.S., because in the rest of the world. So I guess to your point, the importance of financialization, and I agree with you. I agree with that argument. It's hard to overstate that, because it does allow you to unlock the appreciation of these asset prices towards actual consumption and towards actual perceptions of prosperity. I guess asset price appreciation is a very narrow way to look at this, and it doesn't account for these for the cash flow element, the flow versus stock argument. I think of wealth, I think is the key element here.
I mean, let me just say that, so there are like some differences across these countries and then institutional settings that is kind of interesting, and I think we can learn from each other how, this is also a function of how well we are insured against shocks and so on. And the more internationalized maybe the insurance industry it becomes, the better our maybe also the banks become in terms of being more flexible and allowing for different kinds of contracts. For example, the pension system, so the occupational pensions or the defined contribution pensions can in some countries actually be taken out before you retiring. I know, for example, 401k, you can borrow from it. It's very strict how you need to repay and so on. I know Switzerland has that much more flexibly. Italy, Denmark, Sweden doesn't, so we're kind of very strict on that. Of course, there's like a behavioral gradient here as well, so people short-termism and so on and so forth. But it's just like the financialization aspect of how to kind of capitalize on your appreciated home values in terms of living a better life. I mean, so it's interesting to hear. As here, I think this is yet another example of how a dynamic economy like the US can offer new institutional innovations. Maybe not all good. Maybe some of them will backfire. Who knows? But at least it kind of, yeah, as you say, it kind of strengthens, the wealth income complex or connections in this sense in people's daily life.
I wonder if we can maybe shift gears a little bit, and I'm cognizant of time here. I wanted to understand a little bit what might be your policy prescriptions given your work and some of the recommendations that you would have for Sweden, for the West, and maybe for the broader world, because you offer a very positive view of capitalism and of the sort of human ingenuity and innovation, which contrasts, I think, pretty starkly with your colleague Piketty and the idea that you need some wars in order to level the playing field, which can create some pretty perverse incentives if you take that to the extreme, right? So I'm wondering what the policy prescriptions might be and how your work has been received in academia and in broader policymaker circles.
Yeah, thanks for asking. I mean, I think so. An overarching policy insight for me, and I hopefully maybe for some of the readers, is that so the rich are not the problem. So they who have become successful in generating wealth, either by being entrepreneurs or maybe some of them just being lucky. Of course, being lucky to be maybe born in well-functioning Western societies, unlike south of Sahara and Africa and so on. But nonetheless, these people taking part in creating firms that become valuable, offering services and goods and so on, offering jobs that people they get income, they pay taxes. This is adding value to society. So even also for those who love taxes and redistribution should love these private actors, private industry actors who actually generate these incomes and profits that end up being taxed and providing these tax revenues. Uh, so this is just like a first conclusion. Growth is very good for the welfare of societies and also welfare of citizens. And this is like going against some kind of zero sum view of the economy of like, oh, that you have some prosperous and successful people means that someone else has lost out. We don't have that in the economy. We may have it in other settings. We can talk about views of climate policy and resource usage and so on. But when it comes to values, the value creation processes and growth, we don't. I don't think so. So that's just one thing. Growth promotion is very good for society, and that we have successful uh, people in the private industry, private sector. That's very positive, actually. And then when it comes to wealth, so this book is about wealth inequality. So it's not about broader, economic policies in general or economic inequality or welfare inequality or so. But so in terms of wealth ownership, we know that what has equalized wealth is to have people start participating in the economy, so that to make them earn as much, so earn good enough so that they can start saving and investing. And we know historically that what they did was to buy their home and then save for old age. And I still think that that is kind of the backbones or the pillars of people's portfolios. And this is something worth promoting if we can. I think, for example, thanks to like mutual funds, we've started doing this at a much higher level. So we don't need to be experts in the stock market. We can just like buy an index fund and then take part of this, and cheaply so. So to promote private property, private ownership in both in terms of home ownership, or like housing and pensions, I think is very positive. As for pensions, we have a demographical hollowing out in our economy. So fewer and fewer are supposed to support more and more, meaning that we need to think also about the pension system here. This kind of human capital hollowing out or human capital deficit could, I think, in part be counteracted by a building up of financial capital in the pension system. So I'm not the one saying this only. This like Hans Werner Sinn, this ingenious German economist who kind of dominated much of Germany's economic policy discussions for years, has also pointed at this particular aspect of promoting funded pensions. And not only because it's kind of also then part of a productive wealth growth in like when we have growing economies, but also because it kind of makes us rely a little bit less on the traditional pay-as-you-go pension systems, where today's pensioners are get their pension incomes based on the taxes paid by wage earners. So those are, and then on another kind of policy, you could say a broader policy insight, I think, is about and it kind of relate also to the kind of the rich not being the problem, is the kind of the role of money and power. I think power comes in a lot when I talk to people, and why? Well, it used to be like Silvio Berlusconi and Trump. Now it's maybe Musk and Trump, and there are other names. We could have Rupert Murdoch. We could have many like successful individuals building up huge fortunes and then stepping into politics or media or so, and then people get concerned, and maybe rightly so. I think in here being on this positive angle, I think we could look at the countries where this we have been able to kind of strike a balance between having a market economy providing growth and prosperity, and maybe and also super rich people, and yet retaining well-functioning political systems. With we think that there are democratic functions that provide good life, and it's like balanced, and also media that kind of we think offers good information and so on. And here, look, I think it's like learning from these positive examples, I think, is the way forward, instead of just like clanking down on fortunes that we suspect may become influential in the wrong way, but we don't know. So instead, let them do their things. Let the entrepreneurs build their corporations and create value, and try then instead shield off politics from bad political influence. Increase transparency. Maybe have rules against campaign contributions and private like support to politicians, and we could have public service media as one backbone of the media landscape. We could have support for smaller medias. Uh, that's at least the way to go. I mean, what was her name? Lisa Khan in the US. Was the Federal Trade
Lena Khan.
Lena Khan, sorry,
Yeah.
who wanted to kind of break up these big corporations in kind of in preempting the risk of them becoming too influential or whatever. I think this is the wrong way to go. Instead, uh, improve the market economy, and the dynamism. In fact, looking at what's happening, like Nvidia being great. I mean, OpenAI didn't exist 10 years ago. I mean, I'm sure people may stop Googling relatively soon because the new services are coming up. Maybe Google in its dominant position may not be as dominant. And what happens when like India comes up as a major player on like AI based systems and services, and other countries, because we have the open source basis of all this. Who knows? But that kind of, maybe I'm too rosy. I don't know. But the idea is to keep on doing what we do good, namely a market, like a democratically embedded market economy, is kind of the historically, globally, the total dominant example of what we want in terms of creating good lives. And let's try to then shield off that from our democratic uh, arena, media, and so on, in order to, or if we're going to have private media, let's make sure that they are embedded in transparency, and so on. Yeah.
I like it.
If maybe we could spend the last 5 minutes kind of looking forward a little bit. So you brought up OpenAI. Obviously, we've got just unbelievable innovation on the AI front. We've got uh, astonishing, almost mind-blowing innovation and improvement in robotic capabilities. Much of this work is coming out of China. It's crazy, honestly, to see how quickly their robotics programs are advancing. Looking out 3 to 5 years, do you see the potential for a substantial displacement of labor? How might a change in concentrated ownership of the factors of production? Labor has historically been a primary factor of production. The Industrial Revolution obviously mediated that somewhat. The AI revolution and robotics revolution are set to uh, probably profoundly affect that. How does a market economy evolve when the marginal product of labor goes to zero and uh, the factors of production are increasingly owned by a smaller and smaller group of AI and robotic deployment technology companies?
No, yeah, great questions. I mean, actually, I wrote a piece on this very recently. It came out in like in Oxford University Press. No, it was Elgar, maybe, an OECD chapter on AI automation and the implications for the future of tax policy, um, discussing precisely this kind of complex of questions. And I think so. First of all, huge uncertainties. The trajectories are going like maybe or like 180 degrees in opposite directions in terms of when it comes to market concentration, inequality effects, the end of labor or not. I on my end, let me be very concrete and very try to be effective in time. You said three to begin with, 3 to 5 years. Have you heard of Amaro's law? This Roy Amaro, who's kind of said that we tend to overestimate the impact of technological changes in the short run, but we tend to underestimate their effect in the longer run. So I think
Mhm.
3 to 5 years is much too short in terms of seeing huge effects in the labor market, I think, at least in the Western world. Uh, uh, so why? Well, automation has been around for decades. This has been gradual, so we don't see like bank clerks counting bills anymore as they maybe did in the 80s. So things have kind of evolved. I think we're going to a world where almost 100% of the workforce will be employed in the service sector. So production will not be done by humans in the traditional sense of goods, that is, but production of services will be all what we do. Uh, Once again, I'm kind of positive. I think uh, the traditional kind of liberal-minded approach to the market economy would be to make sure that entry is as free as possible. I think that I'm not too worried about these tech giants totally dominating. Uh, and I think because there will be new entrants coming and offering new kinds of robots that are doing things differently. I think why, and also because the gains are huge. So I'm sure there are sitting tons of people around the world trying to think about this. So I think we will have a great deal of dynamism. Uh, So no really like strong need to hardly regulate, specifically with robo taxes or so, or like universal basic income, which is another kind of policy thing that I don't believe in at all, because I think we won't afford a really fully fledged universal basic income, and it will create tensions also, because how to map that with market incomes for those who have jobs and experience productivity growth. So as a system, or like as a specific policy, that won't work, but we will still need, of course, income insurance, so displaced workers, like with any like trade reform, like opening up a trade, we would have like maybe fishermen losing their jobs in richer countries or whatever. Let's support them, and then still having the open markets generating their goods for the majority, for everyone, so to say. Um, so I don't think, and also I think tax policy, or like that kind of policy, won't be, maybe best. We would need some regulation of like maybe data ownership. We need to learn and think hard. Um, but I'm quite positive, actually. I think also when we have more and more robots, they may produce more and more. Their marginal products will also go down. So the kind of their value, value added to the capital owners will also go down. So it's not necessarily so that capital income shares of national income will increase a lot. Uh, at least looking at the last 2, 3, 4 decades, capital shares haven't increased a lot in the world, or in the OECD countries, especially when you account for that some of that capital income is depreciation, so rusting, technological aging, and so on. So the capital needs to be replaced. Taking that into account, like wage shares aren't really falling, maybe with exception for the US, and especially for some industries. But look at look at the data. That's pretty much so. Final point on China. Yes, it's interesting. I think, on going back to the private property rights thing, I think this is what is key for long run evolution, economic development, and growth, and innovation. And we don't have that fully in China. We have commando economy. We have some private property rights for sure, but so far, China, has just imitated, or like they just, or they start this, they have stolen for decades, and now they do things. They do things very well, but it's just not. And it's basically what Stalin did in the 30s and 40s. Amassing productive power, that made people think that this is a solution. Schumpeter at Harvard, he said, like, okay, his book from the 40s, Capitalism, Socialism, and Democracy, was basically, this is the final stage of capitalism, monopoly, production. And several people around, also in the US, accepted this, that this is like Stalin has kind of shown us that this is how it's going to be. Some people now think that China shows us, okay, they're just like so good and so efficient. I think they may be able to do that for some years, maybe decades. But I mean, every new thing comes from below, from people wanting to do things that they love, but also that they think that they can benefit from. That requires these private property rights. So that's my 2 cents on China. And yeah.
Okay. Awesome. Well, there's plenty of other directions that we might go, which might prompt a future conversation, Daniel. But we're sneaking up on an hour 45. Richard, unless you've got a burning question you want to finish with, maybe
I think this is a great place for us to put a pin in the conversation, and we can have a round 2 in the coming months as the response to your work becomes a little bit clearer, and policies start to evolve, especially with the new leadership in the U.S. It'll be interesting to see how that plays out in contrast to some of the other Western policymakers. So thank you very much for coming today, Daniel. This was great.
Yes, thank you.
Thanks, guys. Awesome input and awesome questions. It was a great pleasure speaking to you.
Fantastic. Thank you.
Till next
We'll do
time.
it again soon.
I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.